All right. Hello, everyone. Welcome to another episode of the YouTube channel, the glorious YouTube channel, my YouTube channel. It's called the Ignatius L. Jackson CPA YouTube channel. No, I'm just messing around, but you guys get the point. So we're excited today. We're going to talk to you about the third part and the final part regarding my Accounting Web Live Summit presentation that I did back in May, along with my co-host from the CPA Huddle podcast, Eric Pierre, CPA, and we're going to touch on some of the topics that we discussed during that presentation. It's pretty awesome, pretty cool stuff. I think you guys will enjoy it. Today we're talking about real estate professional status and short-term rental exception regarding real estate. Two key strategies if you want to make some money in real estate and really save yourself a ton of money in taxes. These are two key strategies that you really want to understand and know, because it's going to save you a lot of money. All right, so go ahead and stick around for a second. We're going to be right back and see you soon. All right, and we're back, everyone. Thanks for tuning in today. This is going to be an awesome episode. Before I begin, don't forget to like, subscribe, and give me a review on the channel, all that good stuff. We really love that. We really love you to leave comments, too. Comments are so great, and I actually do try to respond to some of the comments unless I think it's getting too much into tax advice, in which case I'm going to tell you probably need to schedule a consultation. But for the most part, I'll respond to comments here and there. So by all means, please reach out. Go ahead and leave some comments, feedback, positive and negative. I'm okay either way. I just want you to enjoy the presentation and to enjoy the videos. And so any feedback you can give is appreciated. All right, let's get started on this topic. So this is, again, from my Accounting Web Live Summit presentation that I did back in May of 2022. I did this with my co-host from the CPA Huddle, Eric Pierre, CPA. Okay, so here's a little presentation slide about me. You've seen this on the last two parts of this video or this presentation, okay? Here's a little slide on Eric Pierre, CPA, the co-host from the CPA Huddle. Again, you've seen this slide in the last couple of parts as well. And so let's just go right on. And as always, there's a disclaimer here in any presentation that we do, because we want to make sure you understand this is not legal advice or tax advice, and that you really should consult with us on a one-on-one status if you really want to protect yourself, and even get potentially a memo or opinion letter in regards to what you're doing if it's deemed necessary. Okay, if you really want to try to help yourself avoid any potential issues down the line. Okay, all right, so let's hop right on in. Real estate professional status. What is it? Okay, real estate professionals, rental of real estate is not considered a passive activity. So, as you probably know, real estate in general is going to be a passive activity. What does that mean? That ultimately means that if you have losses from that passive activity, they cannot offset your ordinary income, like from your W-2 job, from a business on a Schedule C, from your S corporation, from a partnership, etc. So you're generally not going to be able to offset that other income unless it's deemed passive, okay? So, for example, a business like a Schedule C or a partnership could, in theory, be considered passive income, and you could, in theory, be able to write off your passive losses from real estate against that passive activity. But generally speaking, business activities are going to be more active and more non-passive type income, because you're generally working in the business significantly and materially participating, which makes it essentially non-passive. Okay, so those are just some thoughts and things to consider on why we're even talking about this. Okay, why it's important? Because if you have passive losses and you can't offset against non-passive income, then they basically get suspended and they're just sitting there. They carry over indefinitely, basically, but they're sitting there and you have to use them at some future date when you do have some gains. Okay, so ultimately, here's what we're trying to do. We're trying to be a real estate professional, and that will make the losses not passive. Okay, so here's the qualifications. More than half of all of the services you provide have to be from a real property trade or business. Okay, and the taxpayer must perform at least 750 hours inside of that real property trader business. It doesn't have to be specifically for rental properties. I'm just going to be clear there. It doesn't have to be for rental properties. So it can be for a residential construction. It could be for residential maintenance, like a housekeeping, landscaper, etc., etc. If you're doing stuff for real property on a consistent basis, you likely might qualify as a real estate professional because you're constructing it, you're maintaining it, you're leasing it. There's all kinds of factors that we're going to go into here on what you can do in order to qualify as a real estate professional. Okay, so those are the two key tests. All right, more than half of your time has to be in real property trader business, and you have to spend at least 750 hours in that real property trader business each year in order to qualify for real estate professional status each year. Okay, so the key here that I'm going to say is, if you have a W-2 job that is unrelated to real estate professional trader business, like a real property trader business, and you don't own at least 5% of that company that you have a W-2 job at, then you're not going to be able to use that time at that company to qualify. So even if you work for a construction company as a W-2 employee and you don't own 5% of that business, you're not going to be able to qualify. Okay, so just some things and thoughts to kind of consider and think about is these are the two qualifications. Okay, now what does this mean? Okay, essentially what this means is a real property trader business is essentially one of these things. You're developing it, redeveloping it, constructing it, reconstructing it, acquiring it, converting it, renting it, leasing it, operating it, managing it, or brokering it. So as you can see, those are pretty broad categories. You know, you can get into that in quite a few different ways, okay? But it has to be related to that real property trader business, okay? And it has to be a business that you own at least 5%, like we talked about, and you should be doing at least 750 hours each year in that business, okay? So that's what we're trying to do, all right? That's how you determine what's going on. Now, here's a couple other little key tricks and tips and things that you should consider. As a taxpayer, you can offset non-passive income with losses from real estate rental business if the taxpayer materially participates in the activity. Material participation is important, okay? We're going to talk through later in the presentation what is considered material participation, but essentially there's a number of tests that you can go through, and you have to meet one of those tests in order to be considered materially participating in the rental business. Even if you have a construction company or a landscaping company and you spend more than 750 hours in that, if it doesn't pertain directly to your rental business, then you are not going to be able to materially participate unless you have enough hours directly in that rental business, okay? So don't think you can go hire a property manager and qualify as a real estate professional. Don't think you can go and, let's say you we're going to get into short-term rentals later, but having a cleaning crew that comes and does all the cleaning, and you also have a property manager and you don't really do anything, you're not going to be able to qualify for material participation. All right, and we're going to talk some more about that a little bit later, but that's the key thing there, okay? Cannot count the personal services that the taxpayer performed as an employee in a real property trader business unless you own 5% or more. I already talked about that. Spouses' hours cannot be combined together to meet the thresholds for real estate professional status, okay? One spouse has to qualify on their own, but if one spouse qualifies, both spouses qualify. Isn't that the greatest thing ever? I don't know why the tax code is that way, but it is. And it's if you're filing a joint return, obviously. So if you're filing a joint return and both spouses or one spouse qualifies, then both spouses qualify for their properties as a real estate professional, but you still have to materially participate. And again, we're going to talk about how to get there later on. Okay, short-term rental exception. Okay, so here's the rental exception related to short-term rentals. Sometimes you'll hear this referred to as loophole. Not really a fan of that term, to be perfectly honest. But that said, here's what it is. Okay, they are not considered to be rental activities as defined underneath this regulation. I'm not going to read that to you. If the average period of customer use of the rental property is 7 days or less, average period of customer use for each customer during the year is less than 7 days. So let me just tell you this. If you have a customer who checks in once a month for 7 days, you have to technically combine all those days into one, and so that's going to hurt your average. If you have someone who comes 3 days, someone that comes 4 days, someone that comes 10 days, someone that comes 5 days, your average is going to be less than 7 days for those 4 customers. Okay, so you just have to be able to track, and usually most of the sites that you're using for short-term rentals are going to be able to track the Airbnb, VRBO, that kind of stuff, how many customers you had, how long they stayed, etc. They'll give you a little chart or graph or table or something, and you should be able to calculate it pretty easily. But all that being said, if your average period customer use is less than 7 days, then it's considered a short-term rental. Okay, the average period customer use of the rental property is 30 days or less, and the taxpayer provides significant personal services with the rentals. That's going to be more like your hotel type stuff where you're doing house cleaning or housekeeping every day. You're doing laundry services. You're cooking for them, providing food, drinks, that kind of stuff. If you're doing anything like that, then that can be considered, significant personal services, which has another negative impact of being considered self-employment type income, meaning you also have to pay self-employment taxes. Oh, that sucks. Who likes to pay self-employment taxes? I know I don't. So if you're doing something like that to qualify for the short-term rental exception, you're going to want to be an S corporation to help you save on payroll taxes. Okay. So if you meet the definition of a short-term rental, those are the 2 criteria there. Okay. If you meet one of those definitions, then it is not considered a passive activity by default, as long as you materially participate in the activity. So again, not considered a rental activity. Okay, so it's even though we use the term rental, it's not considered a rental activity underneath the tax code. I know it's kind of weird to understand, but it's not considered a rental activity underneath the tax code, meaning it's going to be active type income unless, right, or non-passive income, whatever you want to call it, unless you're not materially participating. Okay. So as long as you materially participate in the short-term rental activity, you're doing enough work to qualify for material participation, then you're going to be in the short-term rental category, meaning you might be able to offset some of your time in even less than 750 hours spent in the business. Okay, you could potentially get to that point and offset some of your other W-2 income or business income, all right, by doing this exception. This thing is really, really powerful. And short-term rentals are becoming more and more popular, and it's a great little tool, okay? You must qualify each year for this, okay? And the main key, I will tell you, the main key for both of these strategies, the real estate professional and the short-term rental, is you want to actually create losses by doing things like cost segregation studies and having a lot of depreciation and stuff like that. Okay, you're going to want those losses, and you're going to want to be able to use those losses to offset your other income. And you're going to want to do this pretty much every year. You're going to want to buy 1 or 2 properties every year, depending on how much other income you have to offset, so that you can get your income down to as little as possible, as little bit of taxes as possible. Okay, that's what we're trying to do. We want to get it down. Okay, so that's ultimately what we're trying to do with these 2 strategies here. All right. There's no need to qualify as a real estate professional, like I said. It's a great strategy for W-2 employees. I've already mentioned that as well. If the taxpayer provides significant personal services, blah, 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 you're subject to self-employment taxes. I already explained that as well. Okay. I got a little bit ahead of myself in the presentation. I just know this stuff so well. Generally speaking, you're going to put this on Schedule E and not on a Schedule C, because most people are going to qualify underneath the 7 days or less average period of customer use, okay, versus the significant personal services 30 days or less criteria. Okay, so yeah, most people are going to qualify underneath that rule. Okay, and again, significant personal services are going to be things like daily housekeeping, bed and breakfast style, short-term rentals, that kind of thing. Okay, where people are staying for a couple of days, you're giving them some food and breakfast, doing daily housekeeping, etc., etc., etc. All right. Now, I will tell you, this is often confused. This whole thing about where to report short-term rentals is often confused on tax returns. Make sure your tax pro knows and understands what needs to be done. All right, so we talked a lot about material participation, so let's actually define it. All right, so for both strategies, you know where material participation is important. Now let's talk about how to get material participation. Okay, here we go. Taxpayer participated in the activity for more than 500 hours. That one is a difficult one to achieve because it requires a lot of time, but it's one of the easiest ones in terms of being able to prove it. Okay, as long as you have a time log, it's pretty easy to prove. Okay, the taxpayer participation was substantially all the participation in the activity of all individuals for the tax year. That's the second option. That one is very difficult to prove. You have to be really good at tracking stuff because everyone who's doing anything with your short-term rental property, you need to track their hours, and you would have to be doing substantially all, meaning something north of 90% of all the hours that are going into the project. So, for example, if you have someone who spends 10 hours doing, I don't know, some maintenance type stuff that you're not qualified to do, and you're spending 200 hours doing other stuff, that would be considered substantially all in my book, okay, because it's greater than 90%. But you don't want to go down to like 75%, 60%. I mean, that's not substantially all. That's like a majority or a super majority. Substantially all to me is a very high bar. It means like 90%. Okay, so a lot of people are not going to get to that point unless you're doing basically everything in that property, and including the cleaning. Okay, you'd have to be doing everything to get to that point. Okay, the third one, the taxpayer participated in the activity for more than 100 hours during the tax year, and taxpayer participated at least as much as any other individual for the year. This one is probably one of the most common ones that people use. Okay, the reason I say that is it's easier to meet this criteria when you have like one or two properties than it is to meet the 500-hour tests or the substantially all tests. Okay, so all you have to do is work more than 100 hours in the property each year, and no one else, no other individual can do more than you. Okay, so let's talk about this. Cleaning companies. I'm of the opinion that it's by the individual cleaner. So let's say a cleaning company has like 10 people on staff. And let's say you ask the cleaning company, hey, I need you to rotate the staff people who are cleaning my property. I need like, at least 4 or 5 different people to clean this during the year so that no one person gets more than 100 hours of time cleaning the property. Oh, and by the way, cleaning company, can you please share with me how many hours your people are spending cleaning the property each time they clean it? That way I can track it. Okay. These are some of the things that you're going to have to work out with your cleaning company, especially with short-term rentals, because you're doing a lot of turnovers and a lot of cleaning. You got to really be careful with this one. Okay. You will want to, in your short-term rental side of things, be the one managing the property and working with guests, responding to requests, scheduling everything, doing a lot of that stuff. Because if you don't do that aspect, you're probably not going to get anywhere near 100 hours, anywhere near 500 hours, unless you have like a ton of properties, like 50 properties or something crazy like that. In which case, 50 might be a little aggressive. Let's say 20 properties. In which case, where you're doing maybe, I don't know, 50 hours, 25 hours in each property during the year, you could potentially get to that 500-hour test where it doesn't matter how much anyone else is spending on the property during the year. Okay, so but generally speaking, if you have a property manager that's managing your properties, whether it's long-term or short-term, it's going to be very, very hard for you to qualify as a real estate professional or as a short-term rental, as the short-term rental exception, because you probably aren't going to have enough hours to meet these material participation tests. Okay. There are 4 other criteria. We're not going to go through it here because they're not very commonly used. These 3 are the most common. And it's very, very important here that spouse participation counts, and you can combine that together when it comes to material participation. Spouse participation counts in this case. Okay, but you can't count time that you're spending doing the same activity together. So if you're both over there cleaning or you're both over there fixing the maintenance problem at the same time, that's just going to be like 1 hour or whatever it is. Okay, you can't combine those together in that case. Okay. Again, in this case, in the real estate professional case, it's very important to have a time log. You have to be able to prove how much time you spent, what you were doing, where you were doing it, what property was for, how much it costed if you had to buy something. Let's see, when it was, how long it was, obviously. You need yourself a little log that creates this. There are some trackers and apps out there. I'm not going to recommend any particular one, but go and search for them. There are some apps and trackers out there that you can use to help you track this stuff and get yourself a really good log that you can print out and attach to your not attach to your tax return, but attach to your tax records each year, so that you have a copy of that and you know you meet the tests every single year. Okay. Also another thing to note, you want to make sure your tax pro is grouping your short-term rentals together and your long-term rentals together for purposes of meeting these tests. So for short-term rentals, you want them grouped together to meet the material participation tests. Generally speaking, okay, there might be a few exceptions where you may not want to do that, but generally speaking, you want to group it all together to make sure you're meeting the 500-hour tests or one of these other tests, okay? For long-term rentals, you want to group those together in terms of meeting the real estate professional tests and also in terms of meeting the material participation tests. So you want to be able to group all that stuff together so that you can meet these tests, okay? It's very important to do the grouping for material participation purposes, whether you're doing short-term or long-term. In a lot of cases, I will tell you, the majority of the time, you're going to want to do the grouping in order to qualify, okay? So that's it. That's the topic for the day. We talked about real estate professional status. We talked about short-term rental exception. These are great ways to save you money on taxes, okay? Now, the biggest benefit, which we didn't dive into specifically on here, but I'm going to do it on a future episode, is doing a cost segregation study. That's going to give you the biggest amount of loss. Just keep that in mind. You want the biggest amount of loss coming from these activities and offsetting it against your other income. You need to do a cost segregation study in order to meet that criteria. And we're going to talk about that more on a later episode, but I just wanted to at least, have a conversation with you about this. Okay. So hope everybody enjoyed. Again, don't forget, like, subscribe, leave us a comment. We're always open to the feedback, and hopefully you like this video. Let us know, and we'll be back with you with some more good content in the very near future. Bam, 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 bam. All right. Have a good one, everyone. Bye.